Thank you very much for having me this morning. I'm happy it's been 10 years since 2008. It was a rough in munis as well as other markets, and now we've got a lot more stability. Although I'm a direct manager of municipal bond funds, I participate on our global investment committee for Nuveen, and so I'm going to survey more the whole landscape, cover U.S. financial markets versus the rest of the world, talk about some of the most common questions that we get. What does the flattening of the yield curve mean? When is the expansion that's been one of the longest on record, second longest on record, may become the longest on record? When and how might that come to an end, and what does that mean for returns outlook across the financial landscape? And of course, more than happy to we'll touch on municipal bonds, and more than happy to take questions, especially in the fixed income area. For 2018 and U.S. versus the rest of the world, I think it's kind of instructive to take a step back and look at where these various asset classes stand on a year-to-date basis, and what kind of message does that send in terms of what the financial markets are saying about the U.S. economy, U.S. rates, and global rates. And to see U.S. small caps doing the best of all of these asset classes and emerging markets equity doing the worst on a year-to-date basis, I think it's underscored in part by what's been happening in Washington, D.C. Would love to take you away from the Senate hearings and that sort of thing, but it all goes back to Washington, D.C., and that being the tax cut that was implemented at the end of 2017 is having the biggest impact on U.S. domestic economy and U.S. domestic earnings. Small caps are least exposed to another D.C.-based issue, which is the brewing trade war. I would say U.S. versus China is a trade war. Other trading relationships maybe not quite that adversarial, but certainly U.S. and China with tit-for-tat tariff actions are affecting global capital markets. But U.S. small caps benefiting from the increased momentum in the U.S. economy, benefiting from earnings which are earned domestically and less affected by trade war risks, versus emerging market equity and the relationship there with China that most impacted. A quick comment on fixed income and munis. You can see fixed income returns slightly negative on a year-to-date basis, in part due to the Fed, in part due to just the overall shifting higher of the yield curves. Munis have been relatively more resilient. High-grade munis down just 0.5%, even though long-term benchmark AAA rates are up 75 basis points. For municipal bonds, they're benefiting from higher coupons, higher income, more cushion, and credit spreads narrowing. I think they're also benefiting from the fact that the tax cut was heavily skewed towards corporations, less so skewed towards individual investors. That top tax bracket still relatively high at 37%. And with the capping of the deductions, particularly the state and local tax deduction being capped at $10,000, municipal bonds have really attracted capital from upper income and high net worth individuals, and have hung in relatively well in comparison to U.S. government debt or even U.S. corporates. So I'll touch on that a little bit more later. As far as looking at purchasing managers indices in the U.S. versus the Eurozone versus emerging markets, you can see that the U.S. purchasing managers indices are still upwards in the mid-50s, where we've seen some tapering down in the Eurozone and in emerging markets. So U.S. continuing to sort of outperform both on current indicators and leading indicators in terms of the economic outlook. And as such, the Fed of course has raised interest rates 8 times, including just Wednesday, and forecasted another rate increase for December, plus 3 rate increases next year. And the futures markets are Eurodollar futures and Fed funds probability markets options markets have come very close to the Fed's consensus view of that being their rate path for next year. So as you can see, that is also supportive of dollar strength. So Fed raising rates is supportive of the US dollar going up against global currencies. Particularly, I would say the trade war rhetoric kind of exacerbates that as well, in continuing to strengthen the dollar versus peer currencies. As I mentioned, the tax cut was skewed more towards corporations, less so towards individuals. The corporate tax rate going from 35% to 21%. And that has driven about a 17% increase in earnings. So earnings growth outpacing peers fairly significantly in comparison to the Eurozone and emerging markets. So a lot of the return profile that I showed you at the beginning, I think, isn't really driven by valuations. It's much more, in fact, valuations, as I'll show, are a little bit cheaper, but it's much more driven by earnings growth, and in turn, earnings growth, I would say the combination of a 4.2% GDP growth rate, consumer spending running at 3.8%, plus a top tax rate for corporations going from 35% to 21%. That's why you're getting this shape of U.S. earnings growth outpacing global peers. Some of the risks going forward, number one, I would say, if you look at something called the Policy Uncertainty Index, that is University of Chicago and Stanford University have come up with a tracking mechanism of they're tracking the top 100 financially oriented periodicals around the world, and looking at how much mention there is of policy uncertainty in these different topics. So we have trade, monetary policy, fiscal policy, and financial regulation. And I think it's interesting to note, of course, this is trade up here in terms of what the top 100 periodicals in the world are saying about uncertainty around trade policy spiking up like this, whereas the Fed, with their transparency of their forecasts, with their more sort of methodical 1/4 point each quarter of the year, and they're publicizing that they're tracking core PCE deflator to get to 2%, and is exactly at 2% right now for trailing 12 months. Here you have the lowest uncertainty right here is the monetary policy uncertainty. So, and fiscal and financial regulation also fairly moderate. So no question, the number one, for the financial markets, the number one source of uncertainty is trade. When it comes to trade, the U.S. is, frankly, it's better positioned. This measure is simply imports plus exports divided by total GDP. So you can see for the United States, total trade sector, if you will, divided by GDP is about 25%. For the Eurozone is about 90%. For the UK, for example, over 100%. And also, you can't discern it from these numbers, but of course, the U.S. imports plus exports, that's a deficit. So to this extent that gets smaller as a percentage of GDP, it does position the U.S. Overall better. It's not, again, that's why we phrase it as it's not a winner in terms of shrinking of trade. It's not a winner, but it is the U.S. being relatively better positioned. Conversely, China is probably the biggest risk, and the biggest risk to the global economy if a trade war were to be more exacerbated or more extreme on a going forward basis. And you can see one of the top commodities that is tightly correlated to the overall global economy, of course, is copper. The number one consumer of copper in the world is China. And you can see China's currency and the price of copper are tightly correlated to each other. So this is a little bit of what the commodity markets are saying about China currency outlook, China growth outlook, and you can see a sharp decline there. Second theme, how will the U.S. expansion end? What is the meaning of the flattening of the yield curve, and is that a top warning sign? So the yield curve has actually been flattening. This is the 10-year Treasury yield minus the 3-month Treasuries. So this is that 10-year on in component of the yield curve. Now we know the 10 years to 30 years is now only at about 15 basis points of positive slope. This is the slope from 3-month paper to the 10-year Treasury. And 3-month paper to the 10-year Treasury has actually been flattening. It's actually been flattening since 2010, 2011. And it's been flattening since right in here. So it is on a flattening trajectory, but actually that's a very slow trajectory of this flattening out of the yield curve. And in fact, just in the last month, we actually had some steepening. I mean, with the 10-year Treasury selling off from a 280 to a 305 recently, there's actually been just a little bit of steepening here at the end. So on a year-to-date basis, because the 10-year Treasury is up in yield on a year-to-date basis, the flattening of the 3-month to the 10-year, it's only 12 basis points flatter this year. So it could indicate that we have a long runway before the yield curve is actually inverted. And of course, it'll depend how the 10-year Treasury reacts to the next Fed funds rate increase as to whether or not the curve goes inverted. An inversion is not automatically going to trigger a recession in and of itself. And there are some technical issues that are supportive of the 10-year Treasury, and one reason why the 10-year Treasury is not moving up as rapidly as Fed funds has been moving up. But it is a top predictor of recessions historically, and it's also an indication that the Fed has over-tightened. So that's one of the things that people are looking for. Will the Fed over-tighten, and will they invert the curve? So it seems like we have some runway to go before that occurs. And again, the yield curve itself doesn't trigger a recession, but it's a market indicator that the market thinks the Fed has gone too far in tightening monetary conditions. Overall, leading indicators feeding into the New York Fed's model of percent chance of a recession 1 year from now. It has moved up, and this increase from 2015 to the end of 2018 in this New York Fed forecast of a recession 1 year from now, that increase is heavily driven by the flattening of the yield curve, as I mentioned, but it's still only at a 15% chance. So the New York Fed saying only 15% chance of a recession in 2019. Now, so it is up, but it's up off of virtually almost zero type of a level. So that's another issue to watch. Leading indicators are still quite positive. At least in the last 4 recessions, you've needed leading indicators to go negative before a recession occurs 1 year out. So leading indicators are still saying that there's growth ahead for the year 2019, even if it might be decelerating growth because of tightening monetary conditions. The other thing to sort of take a look back over the recovery period, this long recovery period, these are change in private payrolls, so net new jobs added per month to the economy, and it has more of a steady shape. So over the period from 2010 through 3 quarters of the year into 2018, these average monthly payroll adds, right around that 200,000 per month level. There wasn't that 1 year or that one period where there was some huge spike that we would have to then think about rolling over from that big spike. It's a much more smooth shape in this recovery. So this is much more of a slow and steady recovery as opposed to a boom bust. And that could, again, set conditions where one might say, okay, this expansion could still go for a couple more years because this is not a boom bust shape in terms of employment figures. Here's both a positive and a potential negative going forward. we cut taxes without commensurate spending cuts at the end of 2017. So the deficit is expanding. Now, the economy is growing, but the deficit is expanding not only in absolute terms, but the deficit is expanding as a percentage of GDP. As you can see, the deficit expansion as a percentage of GDP is forecasted to go above 4%. Now, that's at the same time that the unemployment rate on the left-hand side, it's at the same time that the unemployment rate has fallen below 4%. So from a pure let's get the economy into a full employment mode, the tax cut, it doesn't make sense in terms of the timing because the job market is already very tight when you throw the fiscal stimulus on top of a tightening labor market and a strengthening economy. Now, that is somewhat offset by offsetting monetary tightening. So we have this fiscal expansion at the same time that the labor market's tight and it's getting into more of that full employment zone. That is a kind of a risky thing to do, and it's offset, at least for now, it's offset by the Fed having raised short-term interest rates 8 times and forecasted to raise short-term interest rates probably at least another 4 times between now and the end of next year, as shown by the Fed's own forecast and then as shown here by the Fed funds futures contracts. What could create a lengthening of the expansion and an increasing growth rate without creating an inflationary environment? Again, so far on inflation, we've seen just this morning was released core PCE deflator for the trailing 12 months came in at exactly 2%. And even the overall PCE deflator is 2.2% for the trailing 12 months. So back up to target in terms of inflation, but not spiking significantly higher. So that's been positive thus far. Now, what could sustain that would be we've only just seen, even though the expansion's been going on since 2010, we've only just started to see this upswing in capital expenditures. So seeing this upswing in capital expenditures, so corporate investment in capacity, this could help what has been kind of a sluggish part of the economic picture here, and that has been productivity has been pretty low. So could one thing that we're looking for and is part of our sort of upside or more positive scenario is if capital expenditures feed into higher productivity, that can create higher growth and a longer expansion without getting snuffed out by inflation that causes the Fed to move a lot faster. So because that is one risk of this sort of boom-bust cycle scenario, is if the Fed is actually behind, even though the statistics don't show that the Fed is behind the curve right now, if it proves that they are behind the curve, then they might have to hurry up their pace of tightening. That could create problems in the economy and financial markets. But if this capital expenditure is invested in a productive way, productivity goes up, then we can sustain a higher level of growth without that happening in terms of the Fed and inflation. Let's try to kind of translate some of these views and some of these information into both valuations of some of the key markets that everybody is looking at and get outlook for different asset classes. So somewhat of a lower return, but not a negative return. Somewhat of a lower return environment and some defensive posturing we think is warranted. Stock valuations, this is using earnings yield compared to real rates. So the U.S. equity risk premium over U.S. Treasuries is right on top of the long-term historical average. So valuations had been low and have kind of come up to long-term historical average. The prospects, looking forward, since the tax cut is producing this roughly 17+% profits growth, and you're not going to be repeating a tax cut again next year. You could have some deceleration in profits growth. So still think that given the economic backdrop that I just mentioned, profits are still going to be going up, but not at that kind of pace. So expect some deceleration in that profits growth. But I think the market has kind of prepared for that. Profits are up a lot more this year than the stock market itself. So valuations are down a little bit, probably in preparation for 2019, where you're not going to repeat that same boost, that same tax cut-driven boost. So this graph, I think, or this picture, I think, presents it well, in that you have the EPS growth of 17%, but you have PE contraction of 10%, and expected return, therefore, expected return of about 6% has been our forecast for the year 2018. A lot of stocks are, of course, ahead of that mark, but that's kind of our overall view, our overall picture for 2018. These charts show some of the reasons why 2017 market versus 2018 market. 2017 market was this smooth and steady ride, with the first year ever that every single month had a positive return for the S&P 500. It's a little bumpier and a little bit lower overall return, even though it's positive, in the year 2018. So we've gone from 2017 near perfect sort of stock market smooth and steady ride higher to somewhat more of a bumpy ride in 2018. There has been more optimism, more positive sentiment indicators, but we would stop short of saying that it's a euphoria type of a feeling. But some of the skepticism has worn off, and so we've gone from a smooth gallop to a little bit more of a bumpy ride, with the biggest risk factors that I think are worth watching and analyzing. The risks of inflation. Again, we have not seen anything meaningfully above 2% as of yet. But we have a tightening labor market with some increase in average hourly earnings. Of course, the protectionism and the trade war that I mentioned. Also, China is trying to gradually reduce some of the speculative nature of its economy and kind of strike that balance between keeping people employed but not overheating the economy and creating a debt bubble. So China managing its own debt bubble, could they create a policy misstep? Is weighing on investors' minds. Now, when it comes to preconditions for a boom-bust cycle, we don't say what was happening in 2007 to predicate what happened following then in 2008. We don't really see that the bubble or market top conditions are in place yet. So we haven't seen a blow-off top. We haven't seen heavy inflows into equity mutual funds. We have seen some pickup in M&A activity and IPO activity, but not over the top. We have seen a little bit of rising real interest rates as well, but some of the rising interest rates are also coincident with rising inflation. So real interest rates are up only moderately. We haven't seen weakening earnings revisions yet. We haven't seen an erosion in the number of stocks making new highs yet. We certainly have not seen a shift into defensives leading the charge, and we have not seen widening credit spreads as of yet either. So the real sell-off indicators, I think, are just not present yet as far as equities. So core fixed income. One of the things we're constantly discussing with investors are when yields rise, investors generally want to sell and want to pull out of fixed income. However, higher yields create higher forward-looking fixed income returns. So, which is shown by this graph here. When yields are at their lows, forward-looking returns are also at their lows. So now that yields are up about 100 basis points, depending on which specific spot on the yield curve you're looking at or which specific fixed income market you're looking at, then your forward-looking returns go up. So, and also, as I mentioned, rates are up a little bit more than inflation is up. So that's real returns on a going forward basis actually look better for core fixed income. And I'll talk about a couple specific fixed income markets too. As far as the credit cycle, rate increases alone don't trigger the end of the credit cycle and widening of credit spreads. In fact, we have a narrowing of credit spreads since the Fed started raising short-term interest rates. Therefore, we still favor, since we think the expansion still has a number of years left to it, based on the comments that I made, we still favor spread sectors rather than sovereign government sectors. So we favor things like preferred securities, high-yield corporates, munis, high-yield munis, emerging market debt offer higher yields with lower correlation to other asset classes. While the Fed's raising rates, the 10-year has held in reasonably well, just above a 3% currently. Actually, the peak in the 10-year yield was actually in late February of this year at a 3.11. And that's been kind of the ceiling this year for the 10-year Treasury. Even while, as I mentioned, probably the biggest concern in the slides that I've shown you thus far, I think, is simply the rising U.S. deficit at a full employment economy, and then continuing to market those U.S. Treasury securities globally. The spread of U.S. government bonds over German bonds, over Japanese bonds, over bonds in the UK, over Italy, which the US has a much higher credit rating than Italy, but these are the largest high-quality sovereign debt markets in the world, and the US has an expanding yield premium over sovereign debt around the globe. It's been offset somewhat by the strengthening dollar, and most of the global investors are going to want to hedge back into their own currency. It is more expensive to hedge back into euros now. It is more expensive to hedge back into Japanese yen. But that relationship is the yield of the 10-year Treasury exceeds the yield of JGBs and German government bonds by enough to pay for hedging costs and still come out a little bit ahead. And so I think that's why we're able to fund the deficit the way we are and still keep yields relatively stable, even though they've been grinding a bit higher this year. As I mentioned a couple of times, the inflation rate on the core PCE has gone to 2%, and the PCE overall at 2.2%. And then inflation expectations, if you look at break-even rates, are right at 2.15%. So the marketplace is saying, okay, the Fed, it may allow inflation to overshoot their target very, very slightly, but ultimately they'll be successful in maintaining that low two-handle type of a target for inflation. And as a result, that doesn't have to pressure the Federal Reserve into a more aggressive policy. So you can see here, these are the 3 Fed tightening cycles before this cycle, and then compare that to the current cycle. And you can see the Fed rate increases in the last 3, 1994, 1999, and 2004 cycles. Those rate increases were a lot steeper, a lot more rapid. This is much more cautious and gradual, both in terms of what's actually happened, but then also what their forecast is. It's for a smoother, gradual, and more flatter type of schedule of rate increases. Our predictions for the 10-year Treasury, 3% by year end, we're basically there right now, 3.25% by mid-year next year for the 10-year Treasury. Shifting into some of the sub-markets within fixed income, one of the interesting things that we've observed in municipals is, even with all the flattening that everybody is talking about with U.S. Treasuries, the muni yield curve is not as flat. The muni yield curve is actually a bit steeper. And that's because munis are 70% dominated by individual investors, and individual investors in the higher income brackets didn't get much of an effective net tax cut, and many people will actually benefit more from municipal income. They're probably not subject to the AMT anymore. If they were previously subject to the AMT, because of the way the tax reform worked, that's going to really reduce the number of people subject to the AMT. In any event, individual investors are dominating the demand profile for municipals this year, and they're positioning themselves shorter in on the yield curve. So what these are muni to treasury ratios in 10 years and in 2 years. The muni to treasury ratio, so what you pay for a muni versus the equivalent duration treasury, the munis only yield about 60% right now of treasuries in the 2-year part of the curve, 85% in the 10-year part of the curve, and over 100% in the 30-year part of the curve. So that's what is making the muni yield curve steeper than the treasury yield curve, because individuals demand munis, but they are buying them short. Meanwhile, the issuances of the municipal bonds, which fund long-term infrastructure projects in the US, the issuance is longer. So the supply is longer, but the demand is shorter. And that's creating that reflective in price, which is also reflective in yield. And that means more yield premium as you go out the curve. The current yield curve as of August 31st, 2018, for munis is that top line, that green line. So you'll notice that it's 100 basis points higher overall, and it is actually a little bit steeper. This is for AAA rated municipals. Not paying anything for the tax exemption relative to treasuries out on the long end of the curve. And that's just for high quality. The other thing about rising rates and fixed income returns, the low yield level for fixed income broadly, and in the United States in particular, was hit in 2016, right in the wake of the Brexit vote. Since that time, municipal bonds have a positive return even across the entire yield curve. The highest return since then has actually been in the 20-year part of the yield curve. And so that might be counterintuitive to people that munis have a positive total return since Brexit, but munis have higher coupons, credit spread, they actually have a shrinking supply rather than an expanding supply, which is, there's an expanding supply in things like corporates and treasuries, and there's a little bit more of a moderation of interest rate sensitivity based on those factors, and these are some of the reasons why munis have exhibited positive returns since 2016, even though rates are up, well off the lows of the Brexit vote. I alluded to this a couple of times, but I think it's useful to take a look at the tax reform legislation of 2017 and what exactly that has meant for the municipal bond market. And there's some influences on supply, and if you look at it from the issuer standpoint, there are some changes that affect the marketplace via tax reform of 2017, and there's also some impacts on the demand side. The number one thing for munis is, first of all, the exemption itself, the municipal tax exemption itself, is maintained. There's nothing retroactive in the legislation. No bonds that have been issued are retroactively being looked at as taxable, as was sometimes that risk crops up from time to time, although I think that's a very low probability that they would ever do that. So it's affirmed that they did not do that, and the tax exemption itself is preserved. In addition, and this is another risk factor going into the debate, every sector of municipal issuance, including airports, toll roads, hospitals, schools, charter schools, industrial development revenue bonds, are all deemed private activity. Now, I think private activity is kind of a misnomer, but for what it's worth, that kind of, I think, confused some members of Congress, and they felt, well, private activity bonds should not be able to be issued on a go-forward basis post-tax reform. Reducing municipal issuance means that, in theory, they could collect more taxes because you would issue taxable bonds instead. There's flaws in that theory, but that was the going forward debate. So after having some scrutiny, some added scrutiny in all of the uses of proceeds for the issuance of municipal bonds, I actually passed that scrutiny, and everything that was able to be issued on a tax-exempt basis before 2017 is also able to be issued on a tax-exempt basis today. So the industry escaped unscathed in terms of the purposes. And I think one of the reasons why the industry escaped unscathed in terms of the purposes of the municipal bond issuances is that they are for infrastructure, and there is, although no infrastructure plan has been unveiled or passed, there is a bipartisan desire to do some things to increase infrastructure spending in the US in general, and that has just I think overall has helped the industry. They did take one sort of nick, if you will, on the industry, and prevented the ability to issue tax-exempt bonds to pre-refund other tax-exempt bonds if they are not immediately callable. So to create pre-refunded bonds with another tax-exempt issue, that can't be done. Now, municipalities are actually still pre-refunding bonds, but they have to come up with the cash in some other way. They can't come up with the cash with a tax-exempt bond. They could come up with the cash with a taxable bond, or bank loans, what have you. So issuance is down for refinancing activity as a result, but it's not down by as much as expected, because new money being issued for new projects is actually up 22% year over year. So municipalities are increasing investment in infrastructure in general, which is positive. On the demand side, as I alluded, fewer people are going to be subject to the AMT this year, and you should check with your accountant. And certain deductions are capped. SALT, the state and local tax deduction, that's capped at $10,000, and your mortgage deduction is capped at a $750,000 mortgage. So your effective tax rate in the higher income brackets might be going up closer to that top rate of 37%. So I think it enhances demand from individual investors for munis, and is somewhat of a slight weakening, although it hasn't been material, a slight weakening of demand from institutions for municipals, because they are the biggest beneficiary of the tax cut from 35% to 21% on the corporate side. But overall, I think given that the industry had some risk, as with virtually every industry, some risk in the tax reform, leading up to the passage, came through actually fairly positively. Taking a step back from munis again and looking at our base case for the overall picture is that we do see global growth continuing to be positive, continuing to recover in spite of trade-related headwinds probably being the biggest source of uncertainty, and still favor risk assets over government guaranteed bonds. The US having probably the biggest pop in 2018 in terms of getting growth over 4% with fiscal stimulus. Monetary tightening is going to be kicking in, so we're looking for deceleration of US growth through 2020. And more equilibrating between growth in the rest of the world versus growth of the US. As we've seen growth in the US shoot up while the rest of the world has been fading slightly, we think that will come back into line with each other. The positive scenario, as I mentioned, is that if US private investment, some of the increased capital expenditures, does generate higher productivity, then we can get better growth and still maintain relatively low inflation. And is the trade war actually a negotiation as opposed to a total shrinkage of trade? That's unknown at this time. But if that were the case, if ultimately this resulted in freer trade, emerging market economies would recover, and emerging markets would probably do very, very well, based on the sell-off that has already occurred on a year-to-date basis in emerging markets. I think is predominantly related to trade uncertainty. Negative side or risk factors are, well, what if the Fed's behind and they suddenly have to get caught up very quickly? I don't think that's the most likely scenario, but this overheating scenario and getting caught up would be certainly a risk factor. We have that same potential risk factor in the ECB if they start tightening monetary policy too quickly and the Eurozone recovery goes back down, including, of course, protectionism as well. And the wild cards, I would say, are coming out of Washington, D.C., and also Chinese government from Chinese fiscal policy adjustments. So the midterms, of course, will be something to watch, and would that translate into impeachment hearings or other implications for trade policy or foreign policy coming out of the midterms? Those are another other wild cards to look out for. And with that as our broad overview, be happy to take any questions.
You mentioned the Treasury yield curve based on the flatness. Obviously, most of the action is on the short end of the Fed. Any perspective on why the long end of the curve is not moving much?
Yeah, I think twofold. It's predominantly been inflation has stayed right at 2%. So we have not seen an overshooting in inflation. We've just seen inflation moving up to target. And then secondly, when you look at very high rated, say AA and AAA rated sovereign government bonds globally, the US yields by far the most in terms of liquid high grade. And there is significant global demand across pension funds, life insurance companies, sovereign wealth funds for diversified dollar-denominated liquid high-quality assets with duration and with some yield in a stable currency. There's actually good demand. So that has been supportive. I guess those two things, global demand, yield premium over and above peers, and inflation staying at right around 2%. Those factors have been kind of the key factors keeping the 10-year to 30-year part of the Treasury yield curve in check.
With the change in interest rates, do you see a change coming in broad market asset allocation away from equities?
We haven't seen that yet. We haven't seen that occur yet. But I think that there is the prospects for it. I mean, I think the reasons why we haven't seen it yet, because interest rates are only up moderately, and we haven't really seen a sharp sell-off in equities. So, and valuations, as I mentioned, valuations in equities are maybe a speck above long-term historical averages, but they're right, in that range, in a range of normal historical averages, and earnings are still moving higher. So for those reasons, we have not seen a reallocation from equity to fixed income generally among asset allocators. I think rates would have to go up by more, and we have to see more stock market volatility, and that would potentially trigger that crossover point.
Sir.
Sure, go ahead.
Can you tell us your view on the state of Illinois and what you think the end game is?
Sure. Well, how much time do you have? Okay, well, a couple quick highlights on Illinois. Going back to, there are a couple key events. First of all, going back to 4th of July last year in 2017, there was, I would say, brinksmanship, political brinksmanship in Illinois, where things actually could have gotten a lot worse for Illinois' fiscal picture, which could have been even severe enough to blow back into the economic picture. And the state legislature, a group of Republicans sort of defected from their party, voted with the Democrats in the state legislature to override a governor's veto of a budget to actually get a budget put into place. And of course, the budget, one of the key features of the budget was that they reversed some of the rollback of the personal income tax, which is 3.75% at the time, and reversed it back up to 4.95. That generates approximately $8 billion in annual revenues. And those, excuse me, those revenues are coming through because the economy's been fairly stable. So that kind of brought Illinois back from the brink. The brink being Illinois could have been the first state in the country ever to be below investment grade. And that's about $26 billion in geo debt in municipals, $26 billion in geo debt going from BBB minus to maybe a BB plus. That would have been kind of a market problem and a problem for Illinois generally because it would then blow through the state and affect other issuers within the state. So that didn't happen. The concern is that that is not a permanent, well, the tax increase is permanent, but the ratings agency's opinion of Illinois GO, that's never permanent. So could that happen in the future? I think the ratings agencies are going to give either a re-elected Rauner administration or a Pritzker administration. They're going to give the new administration some time to see what their policies are going to be going forward before taking ratings action, unless, of course, there's a recession. I would say Illinois is not very well prepared for a recession, given the funding of the pension. But for now, Illinois' revenues are growing, and Illinois' economy is growing. I think the ex-migration of, the outflow of population is sort of exaggerated. It's been extremely small as a percentage of the population of the state of Illinois. I think last year the state lost 13,000 people or something in that vicinity. And in fact, the average annual income and average household income in the state is going higher, and the unemployment rate, like the rest of the country, is going lower. So there's a broad stability in the economy for right now. And that's going to be supportive of the ratings agencies, I think, standing on the sidelines and waiting until the elections are done, and then waiting also to see, if there's a new administration and what those fiscal policy changes might be. So of course the biggest issue is the 39-40% funded ratio of their major pension funds, and lack of ability, because of the state constitution, currently at least, lack of ability to make a meaningful cost cut on those or meaningful reform on those means you just have to pay more into it for the near term. So the biggest issue of Illinois related to peers is that when you add up debt service costs as a percentage of the budget plus pension contribution costs as a percentage of the budget, you're the highest in the country, I believe at around, between 25 and 30%. So those sort of legacy costs, if you call debt service and pension contributions legacy costs, those legacy costs are going up and they're going to chew up more of the budget. So there isn't a ratings or liquidity or market access crisis at the current time, but it's the lowest rated state in the country, and it would still be on a warning track, not this year, I don't believe, but maybe a year from now. We'll have to see what the ratings agencies think about the 2020 budget that would go into place in July 1st of 2019, and the prospects for tax reform, and of course how the economy is performing between then and now. So operating budget with the new 4.95% personal income tax is relatively balanced, is relatively stable. The economy is relatively stable. I think that outmigration of population is totally exaggerated and is not a big concern at this time. But the pension funding and the fixed cost burden and the legacy cost burden and the prospect that that's just going to grow is the biggest risk factor for a future downgrade, even though a downgrade in the near term is not likely at all. Spreads have actually recovered quite a lot. Spreads for Illinois GO got extremely wide for a state GO and recovered, so they got as wide as 250 basis points over AAA, which is extremely high for a state GO, fifth largest state in the country. And they've come in and are currently around 160 basis points. I mean, that's still super wide. I mean, California state GO trades at no spread. And a lot of state GOs would be between 0 and 25 basis points of spread over the AAA. So to be at 100 plus 160 is wide. But it's back from the brink. It's narrowed significantly from the brink, narrowed about 100 basis points.
Sorry, we'd like to take a lot more questions, but we wanted to thank you very much for coming out
Thank
today.
you.
Very informative. Yeah, very nice.
Thanks.